What's going on, Moon Gang? I hope that you're having an absolutely fantastic day. The interview you're about to listen to is with Jay from Special Situations Research, who happens to be an ex-trader from Goldman. He wasn't just any run-of-the-mill trader though. At one point, he was managing a book over $2 billion. That's billion with a B. Throughout this podcast style interview, I'm trying a little bit of a different style, so let me know if you like this in a comment below. It's purely audio, no video. Jay ended up sharing a lot of knowledge on some pretty complicated topics, so feel free to give it a second or third listen. And if you still have any questions, all of Jay's contact information is in the description of this video. I truly hope that you enjoy. Hello. I am here with Jay from Special Situations Research Newsletter. And for those of you who don't know, check it out on Twitter. But Jay, this is going to be an exciting conversation. I'm reading it right here that you used to manage a $2 billion book for Goldman. And I don't think they do that accidentally. I mean, maybe I'm wrong on this one, but I think to be able to get to that level, you might know a thing or two about Wall Street. So I'm excited to have this conversation with you. And I'm excited to really get into some of the specifics that might help empower retail traders, whatever level they're at, to get to the next level. So thank you for your time. Truly appreciate it. How are you doing today?
Hey, how are you? Thanks for having me on here. It's a beautiful Saturday here in Palm Beach. I know that $2 billion might sound like a big number, but Goldman manages about $1.5 trillion today within GSAM, which is their asset management business.
Wow.
At that time, it was a bigger number relative to GSAM, but it's the asset management business is a multi-trillion-dollar business, and some of the bigger mutual funds that you see, like the Fidelity Contra Fund, or magnitudes of this size. The hedge fund space is a constant churn and burn. It's almost a $3 trillion industry, and
Wow.
the average life of a fund is only a few years. So it's an exciting place to be. It's a place where you can learn a lot in a very short amount of time. There are various strategies in the hedge fund world, whether it's long short equity, some of the multi-managers that you read about in the news, whether it's credit, distressed credit, macro, you go on and on, stat arb. There are hundreds of strategies that you could deploy, but the area that I like the most is value, margin of safety investing, and special sits, which tends to focus on event-driven investing, whether it's merger arbitrage, or it's spin-offs, split-offs, dual class share arb, looking at deep value opportunities, and a strategy that's been doing really well for us right now, which is capital structure arb, buying bonds and prefs and then shorting stock against it. So you can fund your stock short with what you're earning on bonds. And even as a retail investor, buying prefs, shorting stock against them on a carry neutral basis, you're not. It's cheaper than buying options because your dividends are essentially covered from what you're earning on the pref, and taking views on companies that you think could either have to issue equity or could underperform in a sideways trending market, or in a market that underperforms. I started. As a first generation, well, actually, my parents moved here. One of the first Indian families to move here in the 60s and 70s, and I grew up as one of the only Indian kids in my school. I went to public school in Connecticut. My family moved out of New York,
Mm-hmm.
and we were dirt poor. My mom and dad were educated. Were very educated in India, but their degrees didn't mean much in the U.S. My dad was a chem major, a physics major. My mom majored in political science. In the first few years my dad lived here, he lived in the basement of an Indian restaurant in Hell's Kitchen,
Oh, wow.
and it was roaches and mice, and if you remember Bryant Park then compared to what it is now, I mean, it was crack dealers, and it was it was unreal before Giuliani came in. There were things I can't even talk about that
Wow.
happened in that basement. And it was, my dad was an entrepreneur, so he got himself out of there, started a scrap metal trading business, and we moved to Connecticut, went to public school there, and the only kid in my school, of color, it was an interesting time. And it wasn't until I started playing sports that I really got involved with community, and I got my first job actually, because Stanford is a big hub for financial services, whether it's UBS, Royal Bank of Scotland, Citigroup, like Mason, and all the hedge funds that are based in Greenwich. Is actually going to church, Gurdwara, which is a Sikh temple, and one of the gentlemen there said he was having layoffs at his firm, so he got me a job. I was installing Bloomberg terminals for people. They used to have, it wasn't like a Bloomberg keyboard like you get now. You had a huge box, like a white box, this keyboard with like red, green, yellow keys. And there are these big shot portfolio managers in Stanford that were managing, mutual funds. And I would go in there, and then they would drop coffee on their keyboard, and I would replace it out and say, hey, you want to grab a lunch or you want to grab a coffee? I want to learn about what you do. Because my family didn't know anything about investing or trading. I almost didn't go to college because I almost missed the cutoff for applying, and taking my SATs. So it was a very interesting experience growing up here. I loved it and built a lot of really good relationships. And I worked my way up from IT to risk management. I went to school on a full ride in Boston, and I was able to work at a international equities quant hedge fund in risk management, and quickly moved to New York. Made my way to Goldman, and rose up the ranks. Their training program was really essential in helping me learn how to model, learn how to read credit documents, learn how to network, which is really essential. And it was a really wild environment at that time. But Goldman was always, more white shoe and, more conservative than the other bulge bracket banks. So like in my 360 review, they would comment, I'd buy my shoes at TJ Maxx, and they would comment, this guy is really smart. He's making us a lot of money, but he has to wear nicer shoes to work.
Oh, that was actually in your report. They're like, we need
in my report that I need to wear nicer shoes. And as a kid, my mom, we would shop at Marshalls and Target, and and I didn't really learn how to dress till I moved to the city. But it was an interesting time. I lived in a gym, because I was paying my mom's mortgage. My parents, split up when I was in college. So I was paying my mom's mortgage back in Connecticut, and I was living in the basement of a gym, not the basement, like the first floor, and nobody knew about it. For a year, I had free rent. I was paying for the monthly,
this is wild,
the monthly
man.
subscription. Yeah. And I was, literally sleeping in where they do the stretching, because you actually had a door to close, and I had a sleeping bag, and I would shower because you have the free showers at the gym, and I would go to work, and no one knew about it for a year, which is, and even when they found out, the gym owner was just like, don't do it again, or I'll cancel your gym membership. I was like, all right.
That's wild. So when this was happening, what is the parallel in your career? Like, what were you doing at that moment? Because I'm almost imagining
at that time I was just an analyst. So what people don't understand is you cannot survive in New York. If you're paying a mortgage and you're living on an analyst salary, I was paying my mom's mortgage at the time. I did not have any residual income, for paying my own rent. So I was surviving on whatever food I would make for myself, and peanut butter jelly sandwiches. I'd go to Wendy's or later, for dinner. But at that time, my metabolism was super high. I had this gym membership, and the goal was just to make it to work on time and be the last one to leave. So New York is a grind. It doesn't matter what industry you're in. Everyone has a story like this, whether you're in marketing. The young women who go to school and have $120,000 in student loan debt and then get paid 40 grand at a marketing firm. How are they surviving? They're surviving with 4 or 5 roommates. So New York in itself, we could talk about for hours. I think everyone who's lived in New York probably has some sort of a similar experience or a story, especially early on.
Do you think that not only coming from like kind of a humble beginning with your family, but then also kind of the grit that is forced upon you by trying to like the iron jungle of New York, do you think that that background had much to do with being like the successful trader that you are,
Oh,
or do you think
absolutely.
you would have had that if you grew up in a better
Absolutely.
situation?
When I was young, my dad would tell me stories because he was frustrated with his life. He would tell me stories about Carl Icahn. He would tell me stories about Soros, right?
Mhm.
Because he would read the Wall Street Journal, and he was always a very like a nerdy guy. He was always reading, he's a physics and chem guy, but he was always into entrepreneurship, and he's in the scrap metal trade. So he'd read about the big traders of the world at that time, and he'd read about Berkshire Hathaway and Warren Buffett. So I was learning about this stuff when I was like 6, 7, 8 years old, and I had no way to channel it.
Mm.
I just love stories. As a kid, my grandfather would tell me stories. So I had a passion for listening to my elders telling me stories. And that's kind of what got me interested in this area. And we had this kind of trading competition in my high school, and I excelled at that. And then, I got that temp job through church and, was able to get a scholarship, and everyone wanted to go to New York. So I found myself in New York, and, just kind of I just happened to fall into this part of the business, not knowing that that it would become my favorite niche within investing. But ended up meeting a lot of smart people along the way. I met William Danoff, who runs a contra fund at Fidelity. Um, he was a mentor, probably without knowing it because we only spoke a couple of times. But I had interned at a number of firms at Boston, so I actually had a few mentors at Fidelity, had a few mentors at State Street, um, and I found myself in New York being at that time it wasn't as diverse as it is now. Having to learn a lot of things that I think a lot of the kids in my analyst class knew, whether it was how to dress, how to properly use cutlery at a formal dinner. Like I had to learn all those things on the job. So for me, it was kind of fun. I was learning new stuff every day. I was learning about different personalities. It was my first time, going to the Hamptons, even knowing what that was. Um, and I spent most of my time just working, right, and learning. And I would not have had that drive if it was not for the background my parents had and their focus on education, or the fact that I knew if I didn't make it and my brothers weren't going to school, my mom wouldn't have a house. So that's, I think, the immigrant story. That's what I think it makes America great, and why I think the country's been so successful. It's about, obviously, it's been about the institutions, about IP protection. It's about the fact that you're bringing the smartest people around the world. It's about the fact that we have the world's reserve currency. But more than that, it the core of America is the immigrant story, and the fact that it attracts people that want to build something new, that want to do better for themselves. And at that time, before big tech, right, the only place you could go, to make to in my opinion, at that time, to make a lot of money and to support a family, was to go to the city and do high finance, whether that was investment banking, restructuring, private equity, hedge funds. That was kind of the the holy grail. So that was kind of my focus through school, to figure out how can I get there. And then when I got there, I just put my head down and grinded. Didn't really go out much or have an adult life till, I was kind of in my late 20s, early 30s.
Wow.
Everything was kind of like a blur. Now, if I look back, it was just working all the time. And I'm not saying that that's the best way to look at your life, but I would say that if you want to be good at anything, um, you need to spend time honing your skills and figuring out what you're good at, right? You read about, some of the great investors, they don't necessarily start out being good at what they're doing. They have to find, whether it's Howard Marks, right, hurting himself, in the Nifty 50 and not being respected, when it comes to equity research, finding convertible bonds and building one of the most successful firms out of that. Whether it's Warren Buffett, who used to buy cigar butts, and then Munger had to teach him, right, how to buy good growing companies, right? That was not how he started off. So I think a lot of investors have to figure out, what they like, what they're good at, what they feel comfortable with, and what allows them to sleep soundly at night. And frankly, what they're passionate about. If you're not passionate about something and you're not willing to put in the hours, you're never going to be good at it, right? Some things come naturally to people, but I would say that, you know, most of it is just how much hours you put in and how smartly you spend your time.
I 100% agree with you. I always thought that was funny between like middle school, high school, and college. You have so many people telling you about like the breadth of experience. All these gen eds do this, do that. We should all be well balanced. And that's great. And I think that works for a large percentage
Yeah,
of the population. But
it
you need
does.
that obsession to, especially now with the, not only like we're so interconnected, there's so much development to achieve the peak in anything. It doesn't matter if it's sports, education, trading, you name the field. If you show me the top person within that said field, they're absolutely obsessed. 24/7, that's what they do. That's why they're the expert. That's why they're the best.
100% agree. So, that kind of led me to an area of investing where, a lot of people may not have experience, especially on the individual investing side. And there's this whole area of investing, special situations, where, the name is used kind of loosely now, but traditionally it was looking at merger arbitrage opportunities, spin-offs, split-offs, dual class share arb, reconversions, MLP conversions, trying to find companies where you have some view on how litigation is going to play out, and you're buying a company at a fraction of what the total proceeds plus market cap, and then net debt is. So there are a lot of different ways to look at investing. Klarman, for example, of Baupost, right? He makes people think that he's this great value investor, but one of his strategies is buying biotech stocks below cash, and figuring out what the run rate is, and you're essentially my entire career has been buying optionality, okay, with a margin of safety. So if you can buy something right below fair value, it doesn't matter how you describe fair value, whether it's a multiples approach, whether you're using a forward earnings metric, whether you're looking at historical multiples and and it's cheap versus a range, or you're looking at the company versus peers or on a free cash flow yield, whether it's free cash flow to the firm, simple free cash flow to equity. If you're buying something cheap to its intrinsic value, right, relative to rates, relative to peers, relative to history, relative to your view on its replacement cost or intrinsic value, like you are going to do relatively well over time with lower risk. And you can even accelerate that you put that on steroids by being flexible across the capital structure. So being able to buy loans and bonds, or even as a retail investor, being able to buy hybrids or preferreds, which is a $1.3 trillion industry, and collect 7 to 12% coupons, right? While being above the equity, right, in a capital structure. Because in a capital structure, for those who are not familiar with it, right, in bankruptcy, in U.S. Chapter 11, Chapter 7, the first lien loans, the revolver, which is a credit card for a company, right, that recovers first, right? It's usually an ABL or a revolver. Then you have a first lien loan, right, which is usually backed by property, the IP of a company, if it's a tech company. Then below that, you have a second lien, okay, which by definition, second lien on the assets or the IP. Below that, you have unsecured bonds. Below that, you have sub-debt, mezzanine, or preferred, and then you have equity. The stuff that we trade in the stock market is a very small representation of the global capital markets, right? The debt markets are bigger than the equity markets. So when we're trading stocks, right, we're trading the residual value, after you pay the government, after you pay CapEx, after you pay taxes, after you pay your debt holders, you have the residual value of the claim on the company, right? The ownership. And in times like these, where you have a sideways trending market, or you have a market where we could go into recession, it makes more sense to be in the higher parts of the capital structure, even as a retail investor. You can do that relatively easily with some of the things that we talk about on our website. Closed-end fund arbitrage, right? Closed-end funds that own these pools of loans and bonds where you can buy them at discounts. Hybrids, looking at preferreds, looking at bonds that you could even trade on Interactive Brokers. Being in T-bills today, you can make 5%. Being in money markets, and people don't necessarily know the difference between the two, and know that, for example, with T-bills, you're not getting taxed by your state or your city. Like there are all these nuances about investing that people don't understand, when they're focused just on, YOLO options or zero DTE or the latest meme stock or the latest tech craze or the latest unprofitable stock that, has a cool brand around it or the latest AI company, right? There's always going to be something hot. The way you are going to generate sustainable, repeatable returns over time and avoid behavioral biases is going to be looking at things that are not sexy at the
Mm.
time. And that's something that, I think the more and more you can understand that, the more and more you'll do well. So for example, in '08, when real estate was not sexy, real estate didn't bottom, by the way, in '08, didn't bottom in '09, didn't bottom in 2010, didn't bottom in 2011. It actually take real estate because only 2% of transactions actually turn over every year, whether it's commercial or residential, especially when rates are rising. Real estate bottoms years after the equity markets bottom. So in 2008, when real estate markets started to bottom 2012, 13 in the Midwest, I started buying up with my first huge bonuses, apartment buildings in the Midwest at like 12, 13, 14% cap rates. And at that time, you could buy like a single unit in Cincinnati, right, for like 30, 40 grand. And you're making a decent rent on that. And, what I was doing was not sexy at the time, right? People had been burned by real estate and they wanted nothing to do with it. So I like to call it like being in the church of what's working now. You never want to be in the church of what's working now. When everyone's buying AMC, you don't necessarily even have to short it. You just don't want to be involved, or you want to make money setting up a business, right? Picks and shovels to take advantage of a trend. You don't want to be involved in the risk taking. When everyone was buying unprofitable tech companies, when Palantir had a 5x valuation, versus where it is now, when people were buying Fubo because they thought that this was going to revolutionize the way we watch television, not understanding that this business was burning billions of dollars and had in my opinion, a net present value of zero
Mm.
during 2001, or when people were buying SPACs, we shorted 81 SPACs on special sits research, just by simply opening financial statements and realizing that the SPAC sponsors were not aligned with investors. And there are all these pipes. These hedge funds were buying pipes. They're a pipe, for those who don't know, is a private investment in a public equity at preferred terms. So they were buying the same equity you were buying as a SPAC common investor, at a 10, 15% discount. Sometimes that discount was made in the form of giving you extra warrants. There are various ways to do it. But these hedge funds were putting all these money in pipes, thinking that in a zero interest rate environment that they were making 10, 15%. And what they were doing is because they were throwing all this money at these SPAC sponsors, these VCs, essentially like Chamath, that all these valuations went to insane levels, 50 to 100 times revenue. And then you had these retail investors who didn't know what was going on, that were committing to putting these money in SPACs that were supposed to be safe because SPACs can only invest in 6-month treasuries or money markets. That part was okay. They didn't understand that after you had the SPAC vote and you went into what they call a de-SPAC, that you didn't have that trust value anymore, that the cash was spent, and 90% of these stocks effectively went down basically to zero, down 80%, 90%, 100%. And that type of mania is driven by behavioral biases, and it's one of the reasons why the stock market is not efficient. And that's why I think special situations make sense, because people get distracted by these big themes, they lose sight of value, and you can find all these like mid cap, niche opportunities that the market's not focused on because they're not sexy. And the fact that half the markets move to either algorithmic trading, right? Even BlackRock, most of what they do is algorithmic trading, or going to ETFs and passive trading. So it's become, in my opinion, it's actually become easier to become a specialist because there are less people doing what I used to do. And for those who don't know what behavioral biases are that cause these unnatural deviations from what valuations should be, they're usually like cognitive errors, or emotional biases, right? And if you were to take like a CFA level 1 or buy a Schweizer book, you could read through them if you're curious. But they're whether it's hindsight bias, or, simply just, looking at what other people are doing and then trying to model your investing profile based on a tweet or based on someone who you have a perception, is doing well, right? It could be belief perseverance error, it could be information processing biases, it could be emotional biases like loss aversion, overconfidence, self-control, status quo endowment, regret aversion. There are all these things we have inside us, right? Understanding the human psychology that cause us to focus on things that are not going to make us money, right? Whether it's Sir Isaac Newton, right, who lost his money, or Einstein, right, who lost all his Nobel Prize money, right? They're the smartest people in the world can succumb, to the market. And, part of what I do is I fight against myself to avoid those things, to avoid the church of what's working now and what's really hot, and to focus on like good, reasonable return opportunities. Whether it's something as simple as like Activision Microsoft, where Microsoft's one of the biggest companies in the world, and then they're offering $95 in cash for Activision, and what the break price is, and it's like a 25% spread. And you can figure out, okay, what the timeline is for antitrust. You can park cash there. Even Warren Buffett, went into that trade after we initiated it. Or whether it's a preferred, finding something that's trading at 16, 17 on a 25 par pref that any retail investor can buy, in October of this past year, that's rallied, 20, 30% while paying you a 7, 8% dividend. Or it's buying a REIT conversion like Colony Capital that, was able to default on its operating company debt because its holding company, the operating company debt was non-recourse to the parent. So you could convert from a hotel REIT and just default on your hotels, preserve your holding company and convert into a digital REIT. There's so many parts of the market, and we're so blessed to have such a robust capital market in the US with so many mid cap and small cap stocks that are not covered by Wall Street. And we can do a whole thing on Wall Street and how the sell side isn't compensated to help you and what their incentives are. There are a lot of ways to make money that people think are just boring and they don't talk about. And that's the focus of our team. We have 9 analysts. I was semi-retired. I'd actually sold the business to a VC firm, and had been kind of retired and just living off multifamily properties and investing my own personal account. But when I saw in October of 2019 that we went to 0 fee trading at Robinhood, and then all the big retail brokers followed them. Even before COVID, you were seeing retail volumes start to increase from like 15 to 20% of total market volume. And by the time COVID hit, it was unreal. Like nobody knew what they were doing. They were all chasing like microcap stocks, chasing companies with high short interest, trying to squeeze investors. Looking at these old brands of declining businesses and memifying them. These crazy option strategies and leap strategies. Like I had a friend who made $6 million like buying leaps on tech stocks and then blew it all. Literally blew it all. Like imagine like thinking you're like God's gift to Earth and like being on cloud 9 and thinking like your grandchildren, colleges are all going to be paid for, and then just losing it all in a year. Like that's kind of the overconfidence we saw.
Wow. Did you want to like shake him? Were you telling him to sell at one point?
I was
Were you
telling
like
him to
lock
just
it in,
cash
lock
out
it in?
like half of it. Like I was trying to be nice to him and say like, hey, just cash out half of it. Like I know you're smarter than me, man. Just cash out half of it. You're going to be happy. And I will tell you that very few of the people that I spoke to in 2020, 2021 listened. And by the time 2022 came around, it was too late. But they're making their way back.
That's exactly like that Dogecoin investor, that guy. I think he took 180K out on credit or something along those lines, up over 3 mil, and then wrote it all the way back down. That's so brutal.
I did read that story. He was a big account, I believe, on Twitter and TikTok, maybe.
Yeah.
And I saw that story and I was like, listen, I felt bad for him. And I just think that we should teach basic financial literacy in high school. Right. But before people go to college, just basic, what is a stock? What is a bond? What is risk management? You need to have build up to having 6 months of your savings. You can always lose your job. like like the basics that your parents would teach you that they don't have time to teach you, or maybe they don't know yourselves. Because the first thing I learned in investing, and sometimes I need to hold myself back because I think that people may not have the same experience. But the first thing I learned was not to use leverage. Leverage kills, right?
Mm.
If you're borrowing money, from a broker to make trades, unless you know you're not going to be 100% right, there's a chance you're gonna get margin called, and you're
Mhm.
gonna lose money at the worst time, because when you get margin called is when you want to buy more, is usually when you want to buy more stock, right? So if you own a stock, let's say it's a great company, AutoZone is one of the best stocks I've owned, and I don't own it anymore because of the valuation. But one of my theses, when you think about value investing, is understanding the story and why the company was going to outperform. So AutoZone and O'Reilly are in they're in the aftermarkets auto parts business, and they have retail storefronts for people to go in and buy parts for their own cars. And in recessions, they actually do well because people want to service their own car and they want cars to last longer.
Mhm.
And the idea was, like 7, 8 years ago, that these companies were going to go away because of Amazon. And as a value investor, I went in, and these companies were trading at above 10% free cash yields, and interest rates were zero at that time. So that was an unreal type of free cash flow to equity. So I went in and I realized I laid out all the main SKUs on the company's websites. I visited 11 of the stores, and then went on Amazon and I looked up each SKU, and I was like, it's actually more expensive on Amazon. And why is that? I spoke to a store manager at AutoZone, and he was like, well, this is the thing. We can afford to sell things cheaper because we have, distribution centers all across the U.S. So does O'Reilly. And on top of that, when you have a car battery, when you return it, you get a credit, right? We can recycle, and you can't mail this stuff to Amazon. It's illegal to mail some of this stuff, so you don't get the credit for these Kohrs. And we have a pretty well-oiled supply chain. And I was like, well, that can't just be it. And what I learned about the industry is that a lot of the mechanics in the US are undocumented, right? They can't have credit cards to use on Amazon. So because they don't have social security numbers and they can't get credit cards, what AutoZone and O'Reilly do is they're huge working capital providers to undocumented mechanics all across the United States. It's a huge business, right? Because you can't get a loan without a social security card either. So what do? You go to AutoZone, you go to O'Reilly, and you say, I'm going to buy all my parts from you, and in return, you extend me credit. So these businesses, had entrenched, across, they have the retail front, and then they have, a part of the business that focuses on mechanics and professionals. And that's what I think Wall Street didn't understand. And, the average 25-year-old sell side analyst didn't understand. And, you can look at the charts since then, and, in the multiple expansion, it's been unbelievable, right? AutoZone's bought like 85% of its shares back because of all the cash it generates. So you have that EPS accretion that's driven the share price to where it is today. And I think like that type of analysis, like people just don't care about, right? It's too much work. Like you were telling me about I was so interested in learning about, your path, Matt. You were
Mhm.
telling me about how you had a passion about algorithmic trading. And you were telling me about how, nobody wanted to watch those videos because no one wanted to learn how to code. And, even before COVID, there are like 4 million open programming jobs in the US. And it's just bizarre. You look at some of the big tech companies today, a lot of their employees are employees on H-1B visas, right? That can't even leave the company. They're stuck at the company until they get their green card. Those are the people that are taking some of the programming jobs today. And I just think it's wild. Unless you do the work, unless you make mistakes, unless you lose money, unless you learn a style that works for you, that's sustainable and repeatable, investing is not for you. And you should just be buying Vanguard index funds, and have some cash on the side, to buy when things go lower. I mean, that should be the strategy for most people if they don't want to spend time on it. And it doesn't matter to me whether that shrinks the number of people that watch this video. I'd rather have people that actually do it the right way than people that just putz around and lose money for no reason.
That's a very fair point. Like that was something that never made sense in my mind. It seemed like some point from, I guess the Rona period until now, all of a sudden there is a very vocal minority that believes doing work and research is just like screaming on Twitter and Reddit and liking and retweeting. I'm not seeing
Right.
anyone diving into
Yeah,
any
that's not research. I mean,
it's not.
we manage a Twitter account that posts like a lot of macro stuff and some specialist oriented stuff. Most of the stuff though is on our website and on our Discord. But the stuff that we do on Twitter, like people think that that's all we, that's the majority. That's the minority of what we do. I mean, we do that to keep people engaged, but
Mhm.
digging into financial statements, building financial models, reaching out to investor relations, even as a retail investor, and having a one-on-one call with someone who's, one person removed from the CFO of a company, reading earnings transcripts, looking at competitors and reading their public filings and figuring out where the company is in the competitive landscape, understanding a supply chain, right? Understanding the risks, like what makes this company great? Is it IP? Is it the brand? Is it customer relationships? Is it low cost of financing? Is it their cash conversion ratio, right? That is the type of work you need to be doing, right? Not just looking at reviews online. Oh my God, I just read a review about Peloton and people love Peloton and it's such a high NPS score. That's the type of research we're doing in 2020. Oh, I read this article on Seeking Alpha. I looked at Peloton's NPS score. It must be the next Apple. And then go like subsequently lose 90% of your net worth, right? Buying one stock. Like that's the type of work people are doing. Just like reading S1s, copy pasting. I mean, that's not how you make money.
Yeah. So with that, to the audience, I think there's going to be some people listening to that who are already very advanced investors, traders who are doing that. But I think a large amount of the audience is like, hey, I got sucked into the market because I was stuck inside during the pandemic. I got some stimulus checks, but now they might have the bug and they might want to elevate themselves to that next level. So obviously, and just for everyone listening to this, the link to Jay's website will be in the description of this video. If like the newsletter that we keep referring to is research that we keep referring to,
and
it will
it's
be
not
there.
just a newsletter. Like I'll share chapters, from books that I read 30 years ago about, think topics that people should know about that don't know about, right? Like what is a money market, how
Mhm.
to open an account, what is a treasury, what is the difference between EBITDA and free cash flow? Like there is a lot of educational material on there. It's not just specialists, it's focused. And it's, I think that, whether you're a basic investor or you're an advanced investor, some of the best feedback I've gotten is from people who are retired in my industry who followed me because they know me and they have $250 million personal accounts, as well as people who are just starting out, right?
Mhm.
Who want to know, what the difference is between, a AAA CLO fund and a municipal bond fund because, their parents lost money and they just want to direct them to read something, right?
Mhm.
The focus is 100% on education.
I love that. Absolutely love that. And like that's actually why I even care about this at all. Is just I see such a staggering amount of just incorrect information getting out there, and then people for whatever reason, and well, the reason is literally because it already supports their bias that they just run with it.
Right.
Everyone
And
will.
people have biases
Mhm.
because they make money off. I mean, think about some of the audiences that people have, right? I think I'm like one of the only people online that says negative things about what I own. Because I frankly don't care. I'm long-term focused and, I'll own something and I'll say, this might not be the best time to own it. And, but I think 90% of people, especially people who are focused on illiquid securities, like in the crypto space or in the SPAC space, right? They seem to think that the only way that their securities are going to do well is if they say something good about them in an audience, regardless of whether they even believe it or not. And that's what gets me riled up. That's why I kind of get angry, because, I've lived through the debt ceiling downgrade of 2011 and I lived through 2008. And when people are going to say that, all of a sudden, treasury yields are going to 10%, and we're going to enter a war, and JP Morgan's going to go bankrupt in a month. A lot of these talking heads were saying in March, and living through like bigger financial crises and seeing the flight to safety into treasuries, which is basically exactly what you ended up seeing in March. There's a flight to safety to U.S. bonds because we're the best of the worst when it comes to our
Mhm.
fiscal situation and our debt situation. Like that type of basic knowledge, I think, is just not there at all on FinTwit. And like you said, you have a lot of misinformation. And some of it is because of biases, but I think some of it is because people are trying to steer individuals in the wrong direction
Yeah, that's fair. Somehow
for
it's
personal
benefiting
reasons.
them, yeah, in one way or another. No, I think that's a very fair point. Maybe to kind of get closer to the wrap up of this, more of a rapid fire type of a deal, we've been talking a lot more of psychology, good research, good education, and really a proper way to think about the market. But for where we are, and just for posterity's sake, we are filming this in mid-April of 2023. And right now we know inflation's coming down. The magnitude of inflation's still high, but we are trending in the right way. So I just want to get your thoughts on the overall state, let's say maybe for the remainder of the year, of the market, of the bond market, and let's say also like crypto. Are you overly bullish, overly bearish? Are you waiting for other information to come in? Or are you just looking for, once again, asymmetric opportunity in like little niche fields?
Sure. I mean, and when you say niche, essentially the hybrid market being a $1.3 trillion market, that's a pretty big niche.
Yeah.
I mean, compared to equities at 30 trillion, in the CLO market, right, as well, being over $1 trillion market, it is a niche compared to equities, but they're still pretty big when it comes to allocation. Now, there are three categories that I think you refer to: equities, credit, or bonds. And when you're talking about bonds, you kind of need to talk about credit and risk-free, right, which is the Treasury benchmark. And then you talk about crypto. So I will be very honest, I'm not very educated in crypto, and it's not an area that I focus on.
Okay.
So for that, I'll just say, historically, the people that I've seen who've done well in it, usually look at, M2, and they usually look at, Fed policy. And, what I've noticed is that M2 has actually been coming down. Just something to think about. And if banks are lending less, because their cost of capital is higher, because now they're losing deposits, and instead of paying zero on deposits, they're borrowing from the FHLB at 5.1%, and they're borrowing at 4.7% from the discount window and the super discount window. You're likely going to see a lack of growth in lending, which is going to slow down the economy. I think that's going to, when you're talking about equities and bonds, with respect to equities, I think that equities are rich. They're too expensive relative to earnings estimates that I think need to be revised lower. If you do any research on this, you'll kind of see what I'm saying in a second, because you look at Wall Street estimates, and while we've been right, and equity earnings estimates for the S&P 500 have been making their way from as high as 235 for this year down to 200. One thing that we are still worried about is that the multiple, if you think about the S&P at 4,100, right, and you say that, okay, the earnings on the S&P this year could be 200. That's a 20 and a half times earnings multiple. And in a vacuum, might say, okay, that's moderately expensive. But then you realize that rates are 5%. That's an extremely expensive equity multiple for where the risk-free rate is, right? If you're thinking about investing and you think that, okay, you can buy, United Health and J&J and build a defensive dividend portfolio, right? Your dividend yield and your earnings yield for a lot of the stocks in the market today is below what you can earn in an investment grade bond. And for many stocks, it's below what you can earn in the risk-free rate in treasuries and T-bills. So I think that people just don't understand, how valuation works. And, if we do another 2 hikes, which I think we may do based on Federal Reserve commentary and based on the fact that wage inflation has been sticky, I think we might do 1 or 2 more hikes, followed by a pause. And the pause might be short-term bullish for equities, but I think what will weigh on the market is that the consumer is getting weaker. If you read the earnings calls from Costco, Walmart, Home Depot, and Lowe's, they're having trouble raising prices. And that means their margins are going to be compressed because wages are still going up. Your cost of capital, right, for debt is going up. And at the top line, your revenues are slowing down because you can't raise prices. And, the consumer is indebted. You have $985 billion of credit card lending. It's the highest it's been for years, right? Credit card borrowing. So it's $1 trillion there. You also have SNAP benefits expiring. On top of that, you have 10 to 17 million people losing their Medicaid from the COVID benefits era. And in June, you have student loans, right? That people haven't had to pay their student loans for 3 years. The average student loan payment in the United States for a citizen is $400 a month. So when you put all those 3 things together, you realize that consumer spending is, 1, it's already fallen. 2, it's probably going to fall more in the second half of the year. and it's going to impact the U.S. economy. At the same time, you have a $21 trillion commercial real estate market. And a lot of commercial real estate loans are floating rate loans with short terms. Now, what does that mean? So if you were looking at the news over the last 2 months, you notice that BlackRock, Brookfield, and PIMCO have defaulted on several loans. Arbor just even defaulted on a multifamily project in Texas, 3,200 apartments. What's happening? Well, if you have a floating rate loan, it's usually benchmarked on a LIBOR or SOFR interest rate. So when LIBOR and SOFR were zero with the Fed funds rate, and you were borrowing at L plus 190 like Brookfield was in downtown LA, you were paying 2%, right, to borrow and you were paying your mortgage based on that. Now that LIBOR is over 5% and SOFR is over 5%, that's 7%. So now you have these buildings in downtown LA that are only 70% occupied. So you're 30% vacancy. So you're suffering there. Then you're paying your maintenance, your CapEx, your taxes, and your interest rate just went up 3x. And I'm not even going to get into where the mezz rates are and where the preferreds are. So you're going to see lenders just walk away from buildings. Now, one thing to note, small banks, which is where the trouble has been, are the biggest lenders to retail properties and office properties, which are the two major areas of where I think where landlords are going to have to walk away from property. So commercial real estate is going to be a drag. We think the consumer is going to be a drag. We think the earnings are going to come down. Now, it doesn't mean it's the end of the world, right? The banking system is still relatively strong. You saw JP Morgan report, you saw Wells Fargo report, you saw Citi report. The earnings will get weaker throughout the year because of loan loss reserves. But overall, corporations have a lot of cash in the US. You look at cash as a percentage of total high yield debt for high yield companies that I follow, it's relatively high versus prior recessions. The wealthy in the U.S., they've done very well in terms of asset appreciation. They've made $7.5 trillion just in real estate appreciation, and you have over $5.25 trillion in money markets and CDs right now. So it's nothing like 2008, and it's nothing like 2002. But I do think we're going into an economic slowdown, and I think that equities are expensive relative to that, and I think that bonds after this rally we saw after the banking crisis are also not as cheap as they were. The short end of the bond curve is relatively cheap. So T-bills, 1-year bonds, money market CDs. We think that there will be an opportunity to get involved in longer duration again. And we think that IG bonds and prefs are super interesting on the short duration side. And even some of the prefs that are perpetual. If you can buy a pref, if you just do the math, there are a number of them we were just buying in March. If you're buying a preferred stock at 18 on 25, right, that means you're buying it at 72 cents. And if that pref pays a 7% dividend, right, if you take a 7% dividend, you divide that by 72 cents, you're essentially making an almost 10% current yield, 9.7%. So if you're clipping 9.7% and you own something at 72, that when interest rates fall, which we think will happen in 2024, you could potentially see that rally from 18 to 25. That means you're making 9.7% plus 25 divided by 18, right? And that is a hefty return for a lot of these names. That's a 38% return in form of capital gains for some of the IG names, plus 9.7%. It's almost a high 40% return, and no one cares, right? Because everyone's just looking at stocks and memes and crypto. So I think that this interest rate environment has created opportunities that you haven't seen in 15 years. And because everyone's so distracted, focused on the stuff they were looking at over the last 3 years, they have no idea where to put their capital. So just to summarize, crypto, I would be a little bit careful because of the decline in money supply. Going into the debt ceiling, obviously with geopolitical risk, if you see, the possibility of some sort of a stimulus, obviously those things can be sensitive. I prefer to be in kind of gold and precious metals and some of the miners. When it comes to yield, we like IG prefs and IG bonds. They're available for all retail investors to do research on. We also like good companies that pay decent dividends. We were in a name MBI. It was an insurance company that was trading at 50% discount to NAV. You can pull it up. Since we talked about it on March 27th, it's just gone up in a straight line because people didn't understand that it wasn't a bank, and you can't cancel policies like you can pull out deposits. Their CVS was an interesting turnaround. That was trading at over a 10% free cash flow yield. Everyone knows CVS, but the company had sold off over 35%. Now there's some reasons for that because of its PBM, because of bonus compensation tied to its Medicare Advantage plan because CVS owns Aetna. But when you actually did the math and figured out, okay, like where are you buying CVS relative to historical comps and even penalizing them for cash flow loss they could see at Aetna and potentially, at the PBM, you were making it at an attractive level. So there are some really interesting opportunities in this market. And within equities, there's another mid cap name called Buford Capital. You probably never have heard of it, but it's a litigation company. And one of my friends was at Eaton Park Capital, which is a Goldman affiliated hedge fund. Eric Mindich was on the same team I was on at Goldman. So they had a big stake in the biggest energy company in Argentina called YPF. Okay, and they essentially, that company was nationalized, and they held out, so they didn't get paid for their shares by the government. Now you fast forward, there's an $11 billion claim across various hedge funds that owned the YPF stock, and the courts just ruled that Argentina now owes that money, and Buford bought the claims. So you have a $3 billion market cap that's just going to get an $11 billion windfall. It's going to take years for them to collect on it, but the stock was trading at $7, and now it's at 12. Like there are things that people just have no idea that they should even be looking at. So my overall view is negative for equities. I like IG bonds. I think high yield will widen out because default rates are going to go up, and we'll have another opportunity to buy high yield bonds at 10, 11, 12% later in the year. And when it comes to crypto, I'll leave it up to the guys that are smarter than me to figure that out. But I do think that precious metals, like if you look at what happened during 2011 and the debt ceiling, there tends to be a lot of fear mongering, and especially with the geopolitical risks that we have now and the fact that central banks all over the world are trying to diversify, right? Some are trying to diversify even from the dollar, and they're buying gold. It's not a bad diversification tool to have a small percentage of experience, but based on the run up, we wouldn't be buying it now. We'd wait for a pullback. I don't like momentum. I'm like anti-momentum. When things are going up, I get scared, and when they come down, when everyone's scared, I try to get involved.
Classic mean reversion. There's two things you said that I would love to dive into. So you're talking about commodities, and you said gold, and you're also talking about solid companies that pay good dividends. So do you have any thoughts on black gold, aka oil? Are you looking at Exxon, Chevron? I know OPEC.
Yeah, so we look at energy in a really weird way. One thing is I'm a long-term uranium bull. I like uranium as a source of energy because I think nuclear, they're going to be, China's building dozens of nuclear plants. India's building new plants. They're building them in Eastern Europe. I was actually involved, most of the time I'm short SPACs, but I was actually involved in a company called SMR. Very early on, it's like the only U.S. company that has been approved to manufacture, produce essentially small modular nuclear reactors that are a lot more efficient than large reactors and can be shut down a lot faster. I'd like to see that more of that technology in the U.S. and Europe. So I think that some of the nuclear companies are very small and speculative. So I try to avoid them. Even in the URNM ETF, a number of those companies don't generate cash flow and they'll need to raise equity. So I try to avoid in a recession type environment. I try to buy the spot commodity because I think eventually it will have to rally to marginal cost. Sprott's essentially buying up all these all the nuclear all the uranium that's being produced. So I like uranium. I like gold. I like the higher quality miners that I own. I like royalty companies. When it comes to oil, I like midstream. I was actually involved in a potential activist situation, the Kane Anderson Fund, the KMF, at a very large discount to net asset value. And Saba Capital is an activist investor. So I noticed that he owned like over 10% of the fund. And we bought it. It was paying like a 10%, almost a 10% dividend. And it owned some of the best midstream companies. So midstream companies, for those who don't know, are companies that own the pipeline and the storage assets in the energy space. So even in a recessionary environment, right, their cash flows are a little bit more protected. And what's happened is that they've paid off a lot of debt over the last 10 years. So they're less levered than they were in the past, and they have lower valuations. I like midstream. I do own some upstream. I own companies that have been good capital allocators that are returning, capital to shareholders. I own several, but one that I'm involved in with Berkshire Hathaway, it, you know, is Occidental Petroleum,
Ooh,
and
me
that's been a
too. I
pretty good
love
risk reward.
Oxy.
It's a great one. I will say that it's not the cheapest one, but it's a large cap name that I think everyone can probably do the research on. Open up their financial statements, you know, go on, read through their presentations, their transcripts. Obviously, they're well managed, and none of this, by the way, is financial advice, but it's just some ideas of the types of things that we're looking at. So right now, we had a very big energy allocation. And by bid, we're well diversified, and we do have a lot of cash, and we do have a lot of yield instruments. We were about 5% weighted in energy going into March, and then when OPEC cut production, you know, and you have to take that cut with a grain of salt because they're already underproducing. So I think the real production cut was probably around 600,000 barrels per day versus the over a million barrels a day you saw in the news. But that cut, resulted in oil rallying very meaningfully, right? And WTI going at one point above 80, and that resulted us selling at a decent profit because we were buying in the 60s, both the Brent ETF, BNO, and USO, which is the WTI ETF, and we sold. We're in the process of selling our energy exposure down from 5% to 3%, but we'll still have a core exposure. And the reason why is we think that even in a slowing economy, Europe could have another energy crisis because they don't have enough LNG storage. And we think that I follow Sufi, who's actually the founder of Cheniere, one of the biggest LNG liquefaction and export facilities in America on the Gulf Coast. He started TEL, which hasn't been as successful because of cost of capital issues. But I think he would agree with me in that there's a very high chance that Europe has another energy crisis if we have a cold winter. Mother Nature was very kind to the world this year with the Ukraine-Russia conflict. We had one of the warmest winters in history. So they're able to not have that issue. But we will always have some exposure to energy with this geopolitical risk. I would be much bigger in energy if I didn't think we were going into a recession. But I've been more conservative on the upstream front.
Oh, love it. I love that insight. To wrap this up, and it was another thing that you touched in, is it's your thesis along with your team that we'll probably see some rate cuts in 2024. Now, obviously, a lot of things can happen between now and then, sure, but that seems to be a common, I guess, mindset that is held. And one thing that I don't get, because I'm 28, I haven't really walked the walk, but I do have the ability to Google and find out how monetary policy has played out in the past. And one thing I don't get is day over day, whether it's FinTwit or media, it seems like everyone is almost giddy. They're excited. They think it's going to be the next bull run as soon as we start cutting rates. But I just did a little bit of a walk down history lane, and I looked at 69, 73, 81, 2000, 2007, 2019. From the rate cut, like the actual cut, every single one of those, we went down. The smallest drop was 27%, and the largest one was 58%.
We're talking about serious. The Fed cuts because they're scared of an economic contraction. I mean, there's a reason, right? So things often go down after the first cut, and it's not until you get to several cuts that the market starts to price in a recovery. We're at the beginning of the economic slowdown. I would say we're probably in the third or fourth inning. We're definitely not at the first inning. We're definitely not at the end of it. So my view is that goods inflation is going to go negative. Okay, I'm saying that here. I know it's controversial. I think by next year, goods in various categories, right? And people aren't focusing on this stuff, but it's funny. Like when egg prices are up 20%, you see it on CNBC, right? Mm-hmm. But egg prices are down 10% in a month. And you don't actually see that, right? And that's not even something that people should focus on because it is, it's because of the flu, an avian flu, and it wasn't even really tied to any of the supply chain issues or anything. But I just use that as an example of the media, right? Following the media is not the best way to invest. They talk about prices when they skyrocket, but are people talking about lumber hitting multi-year lows? No, they're not talking about it. So it's just something, that that I've been focused on. The fact that a lot of goods, whether you look at apparel, whether you look at new car prices, a number of agricultural commodities, some of them have bounced recently, but most of them have been on like a longer term trajectory lower. And then when you look at real estate, OER is about 32% of CPI and 16% of PCE. OER is this owner's equivalent rent. It's a flawed metric, but it lags, right? Because when you think about, rent, when you're polling people, whether it's, actual renters or people that are giving you estimates on where they could rent their properties, right? Like rent isn't priced at one time. Like people's leases, right? People have 1 year leases, 18-month leases, 2 year leases. Like not everything reprices at once. So when rents were going up 20%, right? OER was very low. It was like under 7%. And the market was like, oh, CPI is lying to us. The government's wrong. And they just didn't understand how it was calculated. And now rents are falling in a lot of the United States. And OER is still going to go up because, they're using data that is lagging. So it's something important to understand. Like if you think that real estate prices are going to go down and you think that goods inflation is going to go down, right? Inflation might still be overall positive because of wages and services and certain commodities that have bounced like oil. But overall, there's going to be a massive weight on inflation that's going to allow the Fed to cut in 2024. When you enter a recession, things slow down. There's less lending. There's less M2. There's, big ticket items like boats and cars and homes, those prices fall. And when you have excess supply and people are laid off, then the prices of goods fall as well, and the price of services fall. So I don't think necessarily wages are going to fall, but I think that the path and the pace of wage increases is also going to slow down next year. It would slow down a lot more if we opened up immigration, but that's another 2-hour call. But that's why I think rates are going to get cut down, because we're entering an economic slowdown, and inflation is simply the change in price of a basket of goods year over year. And in order to keep inflation this high, you need prices to go up the same amount every year, right? Mm. So if prices they don't even have to go up if they just stay flat, right? In various categories, it's going to come down. So that's my view. There are a lot of hyperinflationists out there, and most of them, if you were to ask them, to define hyperinflation, they don't even know, right? Hyperinflation, when you think about it, is like what happened in the Weimar Republic, what happened, in Argentina. It's not, 3.5% inflation being, higher than the Fed's 2% mandate. Larry Fink was on TV, and I respect Larry because BlackRock, most people don't know, manages $8.6 trillion, trillion with a T. That's why when you said, the 2 billion comment at the beginning, I was like, you know what, I feel like such a small guy, right? And, they're charging a lower fee, but they're having daily conversations, right, with the Fed. That's how big Larry Fink is. He's talking to the New York Fed all the time. So I was a little bit worried when he said, I expect 3.5% inflation for a couple of years, but I think that, my view is that we'll probably see, 3.5% inflation for 2023. But, I still have a firm view that real estate prices and goods inflation could go negative unless we have an energy crisis in Europe. But if we don't, could go negative, and we could have inflation much lower than 3.5% in 2024. And that would give the Fed some room to avoid another banking crisis, to avoid a real estate crisis, and to cut rates not to zero, but to cut rates, 50 basis points, 100 basis points. And will that be good for some stocks? Yeah, but it's not a panacea.
Man, I truly, truly appreciate these insights. I know there's going to be many people listening to this who are probably thinking there's half the words in here were Greek. So if you guys want to learn a little bit more, understand how a lot of this is connected on the global economic scale, you can follow Jay on Twitter at Special Sits News. This will be in the description of the video. And also his website is specialsitsresearch.com. Once again, in the description of the video. Jay, I truly appreciate your time. I hope you're willing to come back in the future just to discuss whatever the next round of craziness is, but truly very eye-opening. And I think for the average retail trader investor who's listening to this, I'd be willing to bet that they definitely learned a thing or two just to get your insight. So once again, thank you. I appreciate your time, and I hope you enjoy the rest of your day.
Thanks, man. You too. Try to get outside.
Appreciate it. Thanks.